I always enjoy getting a chance to talk to Keystone Financial. We've got Ryan Irvine with me, keystocks.com. Ryan, sorry, I'm just going to throw something at you. I'm looking at the markets. I mean, who isn't on this show at least? And I see this big disconnect between, obviously, it's kind of weird, if you look at the last 20 years, but these incredible valuations. When I look up the size scale, there's always the cliches from the big seven, but you look at the valuations, PE ratios, and I'm going, that's a huge kind of disconnect or difference from smaller caps. Now, you guys do both, but you started
Yes.
as a small cap analyst. And I'm going to ask you more about this, but I want people to know who you guys are at Keystone. And that is, over the years with us at the World Outlook Conference and your research, I mean, you've identified some things, many of our listeners, I hope, will go, oh, yeah, that one. Yeah, because I paid for my college tuition. But the Boyd Auto Group, Hammond Power, we've talked a lot about, and there's others, and I'll get to them. But my point is, you've shown to have an expertise in identifying what were small caps, maybe not as interested for people. And I look at maybe there's an opportunity now because I still see that undervaluation in this kind of a marketplace.
Yeah. Again, thanks for having me on. It's great to be on the show. But yeah, it's one theme that we have positioned ourselves to take advantage of over the past year. It's been this relative valuation gap, as you said, between large and small caps. This past fall, it kind of hit a convergence point. It was the divergence between large caps and small caps reached its highest level in a quarter century, so 25 years. 17.4 was the PE on the large cap S&P 500. The small cap S&P 600, which is profitable small caps, was at 11.5. So it's a 50% plus premium, large caps versus small caps. We saw some excellent opportunities at that point. There's a company that we actually highlighted. I like to always give proof in the results. We recommended a company about a year ago, this time, almost to the day that we're recording this, so it comes to mind. And it was highlighted at the Outlook as well. It's Cipher Pharmaceuticals. It traded at $3.89 at that time. To give you an idea of the valuations that you could buy then, and we're also seeing today, but we bought it at 5 times earnings. 50% of this company's value was in cash with no debt. So it was $3.89 just a year ago to today. It's $16.20 today. And that's the best performing stock on the entire Toronto Stock Exchange. It's 316%. So that valuation gap helped us then. It's narrowed slightly over the course of this year, but I'll look at it today. And if we look at the forward PA on the S&P 500, it's moved up to 20.9. The S&P 600, which is the small cap index, is 14.9, moved up, but it's still a 40% premium large caps are trading at versus small caps. And again, I like to put it in perspective. Over the past 25 years, if you look at the first 20 years of this century, small caps actually, due to their higher growth profile, traded at a premium multiple to their large cap brethren. So it's flipped. That ratio inversion, the continuation of that, it continues to be an opportunity in our mind. And this multiple, if it were to reverse and go back to where we were the first 20 years of this century, there's a significant upside in small caps. That's what we believe.
It's interesting. I know this is sort of simplistic, but I'm thinking in terms of, old guys do this all the time, Ryan. They sit there and they go, I remember Amazon when it was, and I do, $2 to $6 trading range. But my point only being that so many of the stocks we see today and we celebrate, we're small caps. Now, obviously they're not. They've had a growth profile. They were little things. And when you first started doing this, over 25 years ago, I know that when you and I had the pleasure of chatting with you, I love that aspect that you were looking for unrecognized potential there. And so just a couple of questions about that. I mean, you got lots of stocks to choose from. You and your team, you screen hundreds and hundreds of stocks. So what are you exactly looking for? How do you've had this record of, significant success with some of these biggies. I mean, how did you know Boyd Auto Group was going to go up like that? For example, what did you see when they were smaller?
It's such a great question. I mean, not all small caps are created equal.
Yeah.
Obviously, I use the S&P 600 as a metric because it goes into only profitable small caps. So if we were to use the Russell 2000, which is a larger index of small cap stocks, it does not include profitability. So if you did a PE metric on the Russell 2000, you'd actually have a higher PE on that than the average large cap. So it you need to be looking in the right areas in terms of small caps. And as you know, we do a lot of research. We've been doing this for 25 years. To we're looking at the commonalities between what these, like those five names or four names: the Hammond Powers, the Boyds, the Expels, Water Furnace, Janus Systems, all of these 10x plus, like Hammond Powers up 200x. So we learn how the commonalities between these stocks. And there's three elements that we really look for. And all three of these were, again, small cap companies when they were recommended, but all three of them, or all five of them, sorry, were profitable. And all of them were not on the radar of most financial institutions. Now, one could say that maybe that's just five stocks you're looking at. So that's anecdotal. But we look at the data that drives behind the behind the outperformance of small caps and looking to find stocks with that 10x potential. Well, there was a study done. It's a group called Jenga Partners. They
Hmm.
found that, and I'm going to quote this because I think it really is telltale. If you are looking to find the next great growth stock, but 87% of all global stocks that went up 1,000%, so that's your 10x companies or more over the past 10 years, became or began as small to micro cap companies. Now, 82% of those at the start of their ascent, so when they started going up, were profitable, and 91% had a history of profitability. So, uh, to us, the data is clear. You have to start with profitability as a minimum criteria. And in the upcoming webinars, we're going to go do for investors who are looking to find these type of stocks. We're going to detail in very much in detail where the other areas are that you're looking for in terms of what you want to position yourself with the profile of a company that has the potential to grow up 10x over the next 10 years.
Now, actually, when we're talking about this, and you say we do go back a long time, but I remember at first, I didn't have gray hair, by the way, at that point. But at first, it was a great example of why I thought you should, when you go and you subscribe to an independent, research service, investment service, it was exactly why I did, and that is, I understood the methodology and the approach, but I don't have time to do that digging, and I know you guys do deep dives. You actually talk to the people, that kind of stuff.
Yeah, it's
Well,
true.
investors, if you like the style, and that's what I think, is that you find someone who you like the style or where their direction is, or as I say, when you guys first started out, it was actually in this very area. Now, of course, I've loved the work you've done on, dividend paying stocks. Aaron Dunn does a great job with that, measuring what the risk is, what the obviously reward is, what the dividends are. I mean, you do, one of the best recommendations at the Outlook conference, and I'm going back probably 4 years now, was Microsoft.
Yes, yes. I mean,
So
and
I don't want to
a
let
great
people.
growth stock.
Yeah, but exactly. You were not just looking at this, but that's why I still want to come back to this for the very things you're saying, is that potential, is that disconnect, is that opportunity. But it's also like I listen and I go, yeah, I think I'll let those guys make the phone calls. I think I'll let that team, look through all the comparative balance sheets, first of all. That's
Yeah,
another big thing. So,
that's the process of our research. In the Canadian market for 25 years, we have gone through all 3,500 companies, and there's about 2,000 of those that we consider in the small cap arena.
mhm.
And we're growing through from a fundamental balance sheet. We love net cash companies. We love companies that obviously are profitable. That's where we start. And then we interview management teams. We go to conferences. We sit down with them. We do tons of Zoom calls on a daily basis. After this session, I'm going into 2 Zoom calls with companies. That's what we do, interview management teams. So you're looking to interview the intellectual capital behind the company. We've also been building a database because we've been doing this in the Canadian market for a couple decades. We're doing a database now. There's 10,000 companies in the US that we consider small cap companies. And we're doing that same process, bringing that same high quality level of independent research to the US market. And we're really excited to be launching that
Yeah.
next month.
Well, there'll be tons of stuff coming out of that too. And that's what I mean. That screening process is very difficult, phenomenally time consuming, and you need an expertise, that screening process. And it's easier today than when you guys first started, when you did it by hand. At least you have computers to, to do your screening for you. But That's why I think, this group of seminars, and I'll talk about that in a second. I just need the details on it from you. But, what I also do here, Ryan, all the time is I say, okay, give me an example. But that's what the audience wants. Give us some names. We don't know their individual circumstances, but we can recommend stuff that's both on Keystone's radar and they can put on their radar and see if it works for them.
For sure. Well, do you want me to update a couple of names that we talked about 16 months ago on
Yeah,
your
that'd be
show?
great. Yeah.
Just, the three companies that we recommended when we were on in March of 2023. And we can apply some of the same rules that we look at to see when we bought them, say 16 months ago. What are they trading at today? And do we still want to own them going forward? Because that's what we talk about
Yes.
in some upcoming webinars. Now you've had this stock, it's done well or it's done poorly. Either way, what do you do going forward? So the first company we recommended was Firan Technology Group. It's FTG on the TSX. It At that point it was trading at $3. Today it's $6. So it's gone up 100% over that time. It's performed well. Let's talk about what the business does quickly. Supplier of aerospace, defense, electronic products, two divisions, circuits and FTG Aerospace. At the time, it was trading at around 12 times earnings. Today, you're paying about 15 to 16 times. It's a little bit higher than the original recommendation price in terms of valuation, although stock has gone up 100%. It's only gone up in terms of valuation about 25%, but the growth is better. The backlog is higher. The industry outlook is better. So the stock is certainly a hold here for us today. This is not a company we want to exit because we still think it has further legs. So if you bought it at that time, even if you're up 100%, it's reasonable.
Yeah, that's a great point because that's the other side is the buy side. Obviously, it's as an individual sitting there looking at that. Again, their individual circumstances will dictate action. But, how do you guys decide when, okay, so you have categories. We think this is a buy. We think this is a
Yeah.
hold and we think this is a sell. So tell us a little bit about the sell side. What is it just simply that you think the price doesn't justify what you see going forward?
Yeah, it's quite simple, but we'd look at it just like if we were going to invest in that company today.
Mm,
Look at it with fresh eyes. Try to look at it like you didn't own it in the past. Divorce the fact that you actually, hold this company. Look at it with fresh eyes. If the fundamental valuation of the business has outstripped what we think is the intrinsic value and the growth going forward, then we can sell that company. I can use the next update on the company as an
yeah,
example of what the way we would look at it after a stock has gone up again. So this would be VersaBank, symbol VBNK on the TSX, March 2013, 10.15 today, about 16.88. That's 66% higher. So that's good. We like
yeah,
that. What does VersaBank do? Canadian Schedule 1 chartered bank, but they're fully digital, one of the world's first fully digital financial institutions. They primarily make money from point of sale loans. Highly successful doing it in Canada, just entered the US market. So at the time, we actually recommended this stock at $7 to clients. Today, again, it's 16.80. So it's 130% higher. It's actually the same PE or multiple that we're paying for it in the market today, despite the fact it's gone up 130% today as it was then. You could argue it's slightly lower, and given the growth going forward, and we'll chat about this company at our live webinars, but suffice it to say, we're not selling this company today. This is one of the winners we want to continue to hold because it is still trading at the exact same valuation. And we give stories often that we talk to clients and we do seminars about looking at a stock at 250, it doubles to $5 and it's actually cheaper on a
yeah.
valuation basis. That can be said almost for VersaBank today. So that's the way we look at it. Now, if VersaBank, if we bought it at 9 times earnings and today we're trading at 25 times and its growth was only 15%, that might be a reason to sell. So that would be looking at the fundamentals. Does the intrinsic value, does the growth rate going forward, is that under what we think the valuation should be? And if it is, then it might be a time to sell that stock.
Yeah, and that might be a little confusing for people that you say, well, the price has doubled, but then you
Yes,
look and say, guess what? They now own 50 stores, as an example. They now do X more in business. They're now the X more, their profit margins have gone up. Whatever it is, it's just
exactly.
a
Yeah.
better company that justifies a higher price, and you
Yeah.
think it's going forward. Um, let me just throw another quickly before time runs out, because you're doing a full seminar on this stuff. So,
Yep.
what about Geodrill?
Well, Geodrill. So there's an example of a company that is about flat, down about 3.2% from March 2023.
Hmm.
It was trading at $2.75. It's about 266 today. This company is a mineral exploration company. They drill primarily for gold in West Africa, Namibia, Egypt, and Peru. Um, Now, we know this company quite well. So it's a great example of what we're able to do when you know a business well, you know the management team, and you know the fundamentals behind it. Well, this company actually dropped down further over the course of the past year. We were able to recommend it at the World Outlook at $1.68 in that small cap portfolio because we knew the second half of the year was going to be tremendously strong. Well, that's come to fruition. They just released their last quarterly earnings. Earnings were up to 10 cents per share from 4 cents in the same period. So 150% growth. So stock's gone from $1.68 to about 260. But now, because you see that 150% growth in earnings, it's still really trading at 5 times expected cash flow. Low valuation. We still like it here. We'd actually buy it at this price, even though it's gone up from where it was again at the World Outlook. But when you follow these companies, there's often we're looking at them for 4 to 5 years before a recommendation, or they've been in coverage for 5 years. You start to know if there is cyclicality in the business, you know when it is in a cyclical
Hmm.
downtrend and a cyclical uptrend. That just comes from experience, but and watching the markets for a long time, knowing the management team. So again, looking at it fundamentally today, we think it's still a buy.
Now, again, I don't want to sort of torpedo my own questions here by asking you what the time frame, because of course the performance of the company is going to inform some of the
Yeah.
time frame. But a realistic, do you say realistically when you buy something like this is what we're projecting it to do? We're looking at its prospects, all sorts of things. Are you recommending sort of be prepared at least to hold something 1 year or 2 or 3?
Typically 1 to 3 years, but there are some companies that we will put in a specific report on a company that we
Hmm.
put out to our clients. VersaBank, because they've just entered the US market, for example, we're looking to hold for likely 5 to 10 years, unless something
Yeah,
that you
sure,
can't
sure.
see going forward, and you have to have a caveat in there saying something's changed. Geodrill is more cyclical. They serve the gold industry, the mineral industry. So you're again, for us, 1 to 3 years is still short term. So it's more of a 1 to 3 years, and we revise our target on that more frequently because there is more fluctuation. Depends on what the business is doing, but yeah, you have different time frames. But again, for us, 1 to 3 years is really short term. 5 years plus, then we're talking about more long term. But you want a company to perform based on its earnings over time. You got to give it that time to perform too.
Okay, time's a little short, so let me just fire one more, because I always like to do this to you. But give me something. Do you have anything that I should look at that I haven't been watching through Keystone at this
I
point?
I'll be really quick. If you got time, I got two names, but Exco Technologies, XTC on the TSX, $300 million market cap, 780 is where it trades. They're a global designer, developer, dies, molds, components, assembly parts for the automotive industry primarily. Uh, Past several years, the company's made significant investments in technology and acquisitions. Uh, they bought what are called giga presses, giga molds, essentially making large or complicated castings for an automobile, for example,
Hmm.
huge parts. They've made some for Tesla, and they've also made investments in 7 additive or 3D printers where they print up parts. So they're
Wow.
a leader in this segment, gaining market share. But all that capex spending was a drag on profitability. That is over as at September 31st of this year. So going forward, we expect to see way better margins in the business. We've already seen margins come up from about 13.5 to about 17 on an EBITDA basis. That's great. In the last quarter, revenues was flat, but earnings, we're seeing the margins come up 31%. What you're paying for this company today is about 9, 10 times earnings. But we expect earnings to go, and management has guidance on this, and the market is kind of sleeping on it by fiscal 2026. So it's only about, because this company is ending as at September 31st, you're about a year and a half away from these earnings. A buck 50, that would leave the company trading at 5.3 times our expected target of earnings. It pays at a 5.6% dividend, which is well covered. So if you're looking at right now for 2 to 3 years going forward, we think it's an attractive entry point. It's asymmetric in terms of our return profile. If there's a recession, the downside is about $6 to 6.50, so 20% maybe down. The upside, $12 to $15 from 7.80 today, so anywhere from 55 to 95%. We like that asymmetric return potential, and it pays that 5.5% dividend. So we like that.
Okay, we do. I'm going to sneak in one more here quickly, if you don't mind.
Covalon Technologies, COV on the TSX Venture, $75 million market cap. About $9 million of that is in cash, no debt. About $3 is what it trades at. Patient-driven medical device company, but it's wound care, cost-effective wound care, advanced wound care for infections. When you get surgery, the wound care that goes on your wound there. Now, there's strong growth in this business. In the last quarter, 47% revenue growth. That was just released this week. I wish we were on last week, but they came out with great earnings. The stock jumped up. They posted 6 cents in earnings from what was a loss in the same period last year. So tremendous growth there. Similar in the preceding quarter. We expect that to continue going forward. Again, we love balance sheets that are great. 40 cents per share of this company's value is in cash, no debt. They've had a strong run since we recommended them earlier this year, under $2, but still today, about 13.5 times our estimate. We think fair value is closer to $4. Do not chase this stock. It is volatile, but it has reached an inflection point in terms of profitability. And again, we like profitable growth stocks. We talked about that, and this is one of them that we like today.
Well, it's always fascinating to hear the stories, and also, though, I think for people to hear the kind of thinking that goes behind, wanting one stock, not wanting another, like they don't meet those criteria. And I can't think how important that is, or express how important that is for people to have that approach, professional approach. But that's why I'm telling you this. I love this idea of a webinar. That you're doing a webinar is how to find the next 10x stocks. Hey, sign me up. It's I've got the dates here for you. It's August 27th. Pardon me. It's next week. August 27th. Start with 7 p.m. Pacific time. You're doing another one the following week, September 5th, 7 p.m. Eastern time. I'm going to put all that detail up on mikesmoneytalks.ca and on our social media. But there is an early bird ticket. That's why I wanted to get this out there right away at basically $29.95. I mean, my goodness gracious. Just let me ask one or two questions quickly. Obviously, you're going to be expressing your approach, the kinds of things that we've touched on here. How long is the webinar?
It's around 2 hours. We have a Q&A at the end as well. So you can, we'll take questions for as long as people want to be in there. We'll have 3 or 4 of our analysts in there, and we'll answer your questions on any small caps, really any investing topics that you want to talk about. Those are always great to have at the end. So we'll extend it as long as we need to for those Q&A sessions. But yeah, we're really going to talk about focusing on effectively investing in Canadian and US small cap stocks, giving the commonalities of some of the stocks we've recommended in the past that have gone up 10x, and how can we use that profile of those businesses to find more companies like that and get them into a portfolio that's structured well to take advantage of those small cap opportunities.
No, as I say, we'll put that up on mikesmoneytalks.ca and our social media, but also go to keystocks.com, keystocks.com. You'll have it right there. I just think that's a great idea. I think there's a ton of interest in that stuff. But again, way too much of that style of investing, or let's say on the more smaller growth, more speculative end, is not done with a disciplined approach to it, a disciplined list of what are you looking for. And as you say, it's a proven track record. So, good on you. But that's August 27th, 7 p.m. Pacific. You're also doing it September 5, 7 p.m. Eastern, 7 p.m. Eastern. So let's take advantage of it. But I would have a look at that because, as I say, I think that's a fascinating side of the market with people who've got a good track record. Ryan, thank you for taking the time.
Thank you so much for having me on today. And I always wish listeners profitable investing. Look at those companies with profitable results, and then you can have some profitable investing.
Great stuff.
Have a good day. Thanks.